So hey everyone, it's Tim Royster here with the Royster Hearth Group of Compass, and I'm here with Patrick Holland of Embrace Loans, one of the best lenders we have in the area, brings sound advice to our clients. Pat, talk to us what's going on. I had some questions because obviously since Friday, interest rates just started going up pretty fast. I had thought, well, why don't we consider just buying down the rate and then maybe if we're instead of doing 15% down, maybe do a 10% down and put that money that way.
Interest rates have gone up 3% in 6 months. They went up 0.5% since Friday. So there are some knee-jerk reactions to now I can't buy, or or I shouldn't buy. I need to wait. I mean, there's all types of negative discussions that are going around, but if you look through the course of history, after recessions, after debacles, there is typically significant gains in the marketplace, whether it's housing, whether it's the stock market, whether it's this or that. I for one, I'm 47 years old. I've lived through a couple market changes in my industry, in my 17-year career in the mortgage industry. So we are now doing whatever we can to combat the problem right here in front of us that we're being very reactionary. So yes, people can always use money to buy down the interest rate, but most people don't understand that it's not a one-for-one buy down. For example, and just use for our discussion today, Tim, let's just say that an individual has a $500,000 loan. 1 point would be $5,000. 2 points would be $10,000. And a lot of people say, oh, I'm going to pay 2 points. I'm going to drop my rate from 6% to 3% or 2% or whatever. It's not a one-for-one buy down. You typically can move it incrementally down, maybe an eighth or a quarter or maybe 3/8 of a point, with some significant upfront investment. Now, whenever we're talking with our clients, we try to use return on investment in everything we do. If we take $1 now and we pay in advance, what is the break-even point or the return on investment of that money? So, for example, and this is just for math reasons, we'll use it, but let's just say we spend $5,000 and we're going to save $40 a month. Well, if we take that $5,000 divided by 40, our break-even point is going to be, 40 to 50 months, even more, double that, down the road. And again, poor example, but on that one, but let's just say it's even $60 a month we're going to save. So if we take 5,000 and we divide it by $60 a month, well, am I going to really be in this home 75 months from now? Or am I going to be in this interest rate 75 months from now? Most people, even in a changing rate environment, buy a new home, and these are the statistics. They buy a new home every 7 to 8 years, and they refinance every 4. So we want to look at the break-even point and the value of that dollar spent now, and how long are we going to recover that going into the future. There is some speculation that as the interest rates go up like they're doing post this recessionary period that we're in and inflationary period, we could see rates drop. There's a very good chance that people that are buying homes today are going to refinance within 2 years. So if that's the case, was it a good buy down or not? And again, speculation.
Yeah.
But the main point is, Tim, is to provide as many options to the buyers and to the clients as possible.
One of those questions you have to ask them is, life changes when you ask your clients, life changes, or what do you expect? How do you see yourself in 5, 7, 10 years? Are you going to get married? Are you looking at another job? Are you only here temporarily? Military people or folks that are military, they PCS, but they know they'll be here for 3, 4 years. They'll buy, but they know it's not their forever house because they're going to go somewhere else when they retire. There's all these different scenarios. And I think that you have to look at all that. Like you said, you have to look at all of this when you make these decisions, because like you said, it's today's dollar for a future projection. And so we have to make sure that we're doing this the right way when we're calculating where do I invest and put my money when I buy this, when I purchase this home. So
Yep.
very good point.
Yeah, and more importantly, in that initial conversation when somebody is looking at becoming a homeowner, I for one don't take that. That is a light, buying. It's kind of like if you look at the big boy and girl things you do in life. After you get out of college, getting married, having children, buying a house. That's one of the big three things. You should go into, those types of decisions knowing and as much as possible. When I became a father for the first time, I kind of had to learn as I went. It was a lot easier with the second child than the first, because you had done it before. But oftentimes when you're making that first home purchase, you don't have a lot of the long-term answers, but a lot of times when we evaluate a home buyer, we ask some very probing questions. How long do you expect to be in this home? Oh, I don't know, Pat, but we think this is going to be a starter home for us. Well, that's a key. That should, ding, ding, ding. Okay, that is something there. This is not a forever home. So should we worry about paying it off? Probably not. Well, okay, if it's not going to be your long-term home, do you think that this home might be part of your long-term investment strategy? Real estate, whenever you're talking about a portfolio for people, most people just think it's stocks, bonds, and cash, or some types of insurance. They forget that a lot of wealth comes from if an individual owns a home or not. Yeah. Regardless of the marketplace, and I'm not just saying this because I'm in the business of mortgages and real estate. It has been financially proven that an individual that has home ownership as part of their overall portfolio has a lot more wealth. In fact, 70% more wealth when it comes time for retirement. And that comes from a Forbes statistic. And even I've read it in the Wall Street Journal a few times over my career that, it's very evident to see that people that own homes have a leg up in retirement. Markets are going to change. There's going to be buyers markets. There's going to be sellers markets. There's going to be ebbs and flows. But if you look at statistical data over the last 40 years, it's not always up and up. It's not a straight line up, but it looks like it from afar. But there are some blips along the way, and you just have to make sure your entry points are taken into consideration when making decisions. If an individual is going to make real estate part of their long-term portfolio, maybe a fixed rate mortgage makes more sense than an adjustable rate mortgage. Because when you have an investment property, it is more expensive to refinance and or leverage that home once you are not in that home as a primary residence. So there's so many factors that go into making sure an individual is educated when making a home buying decision.
The average time that someone stays in a home is going close to 10 years. I think it's going to be interesting moving forward to see, because of the low inventory levels that we've seen, a lot of that is because people refinanced and they're staying in their homes longer than they had before. So, tell us what we're looking at here really quickly, because I want to ask you about this 30-year, the mortgage-backed securities. Tell us what we're seeing. That way, may make sense of these numbers.
Yeah.
And what that means to you as a mortgage professional.
So we are constantly watching the ebbs and flows of the market, and some of the things that we try to evaluate, and when we're advising our clients, and I'm actually going to scroll down just a little bit here. And these factors here kind of show the trends and where the markets are going. Now, green is good, red is bad. We have had, especially since this past Friday, we saw the markets fall off a cliff. Like, if you look back where it says June 6th here, highlight a little bit here, and then June 8th, there's June 9th, and then boom, we just kind of fell off that cliff over the last few days. This is where there was a lot of media discussions of what the Federal Reserve was going to come and do this upcoming week. The meeting started yesterday, and they're going to announce and have a actual press conference. I think it's 2:00, maybe 2:30 today is when they're going to really, announce to the public. But the core inflation numbers on Friday were really bad. They were higher than expected. And that caused an immediate, what I like to refer to the boulder in the bathtub. You drop a boulder in the bathtub, water goes everywhere, and the markets and the media and individuals, I mean the markets, I mean the stock market, I mean the bond market, the treasury, where individuals are investing their dollar, looking for yield or profit in the marketplace. So we've seen a significant sell-off in the stock market. We've seen a significant sell-off in mortgage-backed securities and treasuries. And a lot of people have gone to safe haven, which appears to be cash. But as everyone has talked about, okay, your dollar is not worth a dollar anymore. It's actually worth about 91 cents right now. So the dollar is actually not even holding value. So because your cost of good that you're buying, is gone up. So what we're looking at here is just the overall activity in the marketplace. So we've had a couple really bad days, but we did bounce off of the floor, last night. And as of today, and I don't know if this is going to continue, but we're seeing a 50 point turn in the S&P, which, we're still down 20% on the year. The Nasdaq's down 35 and the Dow is down 23. So a 50 point movement is really not earth shattering. Now, if we got back up to, 4,200, 4,300 on the S&P, then now we're talking, but we're not seeing that type of recovery, and it's going to take a while. Over here to the left, a 50 basis point turn in direction on the mortgage-backed securities. Well, we're down 230 in the last 3 trading days. So again, we're barely making a dent, but it is a bounce off the bottom. Now, doesn't mean we're going to go up now and be positive, but it's that leveling effect that we're seeing a couple days after the boulder in the bathtub. The same thing with the 10-year Treasury. The 10-year Treasury hit 3.5 at one point over the last few days. That is up over 230 points, or up from 0.8 less than a year ago. So we are seeing significant market adjustments. But a lot of those were, remember, back in 2020, interest rates dropped significantly because of the infusion of stimulus because of COVID. The Federal Reserve and government acted to keep the economy going. Money and cash keeps the economy rolling. It's like if you have a fire and you want to keep that fire going, you either the government has to put money on it to keep the fire going, or consumers have to spend. So whether it's buying goods and services, whether it's buying homes or this or whatever, when all of a sudden people go, oh my God, I got to start saving, and money comes out of the market, the fire starts to go down. So in order for people to get into the market, well, it costs more. There has to be enticement for other individuals to get into the market. Therefore, prices go up to do that. So that's what we're seeing right now. And that's what we're watching, and that is reflected in mortgage rates and people. The cost of borrowing money is greater, but I do believe, and I'm regurgitating some information from my superiors as well as I'm no expert in terms of speculation, but I'm taking the information that I'm receiving from the industry leaders, and we do expect interest rates to drop again, next year, the following year. So people that are buying homes today, which I mean, there is still a shortage of homes. The laws of supply and demand, yes, will be tested a little bit because the cost of buying homes is still very high, with the interest rates, but there's still a 4 million home shortage nationwide. And there are more people coming of age every day that need a home, that are not going to be staying in mom and dad's basement forever.
What you just hit on is really interesting to talk about, because I mean, all that data it's neat to watch how you just talk about how the mortgage-backed securities and what we see, the Treasury and how they are reacting to each other. And then the information that came out on Friday and how they reacted to that and how the interest rates went up, because I like the bolder idea though, because yeah, things do even out eventually here. It happened. It happened earlier. There was a nice steadiness in the market with interest rates that I was hearing from you and from our buyers. They're like, oh yeah, they're starting to steady out a few weeks ago, and then
Yep.
we did this information. So I think what we have to understand as you as a mortgage professional and us as realtors in advising our clients is that we're not buying for selling the house next year. We're not
Correct.
buying to sell our house in 2 years. We don't buy homes to turn out to flip it, right? And so we're not here to say, hey, this is the best time to buy. This is the best time to sell. I'm here to say, and I think you are too, is like, let's think about this. How does buying the home, how does selling the home fit into your overall where you want to go with your life? Where do you see yourself right now? And so, and it goes back to what you just said. I think it's so important is that it would be interesting to see how many times a person actually refinances a home if they live in it 15, 20 years. And then how many people actually in those 15, 20 years actually stayed in their home that long. It's not uncommon. We did 12. That was a long time for our last house. We did 12. And then we bought another house and we turned that into a rental. But we did it a little longer because we had little things, seasons of life changed, like you said. And we said, we'll wait it out. And then we saw the opportunity. And so tell us, I mean, you said this, that it's potentially, we obviously don't have a crystal ball, but it's cyclical. And there could be, you could buy the home that you want, the community, the area of town you want to be in now, and maybe have an opportunity in the future, maybe sooner than later, we don't know, to be able to refinance because it would be the smart thing to do. And going along with that, Pat, when is it usually, let's get people's mindset around that. When is it usually a good time to be considering a refinance if it's not happening now?
Sure. So in just overall part of the plan, like if you were to go and we've talked about financial planners before, Tim. We met with one last week, and had a really good discussion and how they approach when they're sitting down, how they use real estate as part of the overall portfolio.
Right.
When you're talking with the client, and there are some people that buy homes for investments. They go in, they renovate, they flip, and they churn them. That's one type of real estate purchasing. Then you've got your home buyer that, okay, this is going to be shelter because I know I'm going to be here 3 to 5 years. Whether I'm military or this is a first home, I might be getting married or something. We strategize for that. Oftentimes what we do is we are solutioning for today, but putting plans in place that if interest rates do change or drop, at what point would we look at a refinance? It could be, is it based on how much equity might be in the home at a certain point? We have individuals that may be using a certain mortgage program right now because it is the only option available due to maybe a situation like divorce, like they got divorced and they had to buy something or refinance into a situation because one individual had to get out of the property. And maybe we're restoring credit and getting them, they had to go with this type of loan for right now. And then as soon as we get a credit score to this number or the equity in the house to this number, we're going to refinance you into this. Some people will change the term of their loan. Okay, I wanted to do a 30, but you know what? I want to actually pay it off faster. Is it better to go to a 15 or apply more principal to it? Or maybe I had to sell another home to get the rest of that money out and then drop it against this mortgage, and then we move forward and restructure. There's the beautiful thing about what I do and what you do. There is no one answer for every situation. And that's where going through and putting a plan together. And, and that's why I like even, and I like sports analogies. And, the quarterback may go up to the line getting ready to call a certain play, but depending upon how the defense is set up, they may call an audible right there at the line and say, we all love Peyton Manning, Omaha. And they change the plan right there. And now they have to adjust for another life-changing event. Yeah. And that is the great, and that's why, although my industry and my job is very stressful, it's also very rewarding. And you and I we've worked on transactions together where we help them buy their first home. We've refined. Oh, now we're on their second home. And Tim, we've even got one where they're on their third home with us. In the past 8 years, because I know, and so it's great that if you've done the work like we've done with our clients and built that rapport, that they just know, I just need to call Tim or I got to call Pat and just talk through what might be going on.
Yeah.
And I know I'm going to sound like a broken record, but we go into a situation with answering as many of the variables that we can, knowing that we're not going to know them all. But if we can solution for as many possible outcomes, we can help our clients plan accordingly for short term and long term, and we're going to make the best decision that is in the present. And we don't know the future, but if it works now, and we plan them and help them plan for now, knowing that most people are going to be getting raises at work or this or that, or we're hopefully going to put them in a really good position for long term.
There's so many solutions and so many options that people are just not aware of, and those headlines don't talk about.
And those headlines may or may not apply to you.
Yes.
But because right now we're so there's so much stimulation, and we're getting so much, and a lot of it is negative, and maybe rightfully so right now. But negativity sells, and that's why we see it everywhere. It's on it's on all our social media and this and that. But but right now, housing is such a huge part of our national GDP.
Yeah.
There's going to be ebbs and flows, ups and downs, but man, housing is so important that there's going to be help along the way. If it starts getting really bad, there will be help along the way. There always is, and things change. That's why it goes up and down, but left and right. But long term, ask all our people are they happy they bought homes in 15, 16, 17, 18, 19, 20, 21, and they've seen their homes appreciate. Even people that, like, I went through a housing correction we all did from 2007 or 8 when we bought to 2012. But you know what? Okay, so I have, if you were to buy 5 stocks, a couple of those are going to be bad, a couple of them are going to be good. And overall, if you look at your portfolio is still higher than what it was. I mean, so Tim, we've been talking about the finance side, but right now, like, I've got 40, 50 individuals, and I'm just one mortgage originator. I mean, you are out there in the field every day at a big company that has, hundreds of real estate professionals. What are you seeing from your team and your company? What are they reporting about, days on market? Is there still crept up demand and not enough homes out there? I mean, when you're getting contracts, and what are that you're seeing or updates, and how mortgage rates affect? Have you seen the impact yet?
Yeah, I think we are at certain price points. Actually, part of our video, we'll be talking about this today too, is that we looked at the median days on market for the last 3 months. Okay, let's talk about what's happened in the last 3 months. Interest rates, they went up, considerably over 3 months. And there was this idea that, well, maybe the days on market would change. And even over the last 3 months, and this would be all of even May data, the days on market was still the same. And it's actually, I think I'm looking at it, but I think it's 5 days. 5. Now, days on market for all of Fairfax County. This is Fairfax County single family homes. All right, I wanted to try to get that pool a little bit tighter to get that, but we've been tracking those each one, and they all were the same. Now that's interesting, right? Now, was the average sales price come down a little bit? Sorry, the median sales price, it did. The median sales price came down. So what, did it come down drastically? No. I'll show you the graph on that. I already have the graph done, but the median sales price did come down, but the days on market, what did that mean? That meant that sellers were also understanding the dynamics of an interest rate hike and what that meant to what their value was. Now, did that mean that they're selling their home for less money than the neighbor? Possibly, but they also were the same people that were enjoying the 18 to 20% equity that they've received over the last year and a half because of the interest rate. So, it goes back to what we just talked about 20 minutes ago. Selling and buying at the right time, you can't time it. It's when you're ready for the next season of life. And the thing right now is that, you need to be prepared that the properties that are staying in the market, the ones that are seeing a price reduction, were the ones that just were a little bit off from where they should have been. And now, because of the interest rates, we have to be a little sensitive to that for buyers. And it's just happens with the season of what it is with real estate. Now, are there more properties coming to the market? A little bit. Is it where we need to be? No. The buyer demand's still there. Are we seeing 8, 10, 15 offers on every home? Absolutely not. But if you remember, you remember this, Pat, before the pandemic, we were still getting 3 to 5 offers on homes, and that would be a multiple offer situation. And so it was still about the price and the terms for that buyer. And it's the same situation. So we always keep counseling our buyers. Yeah, we're in a market where the affordability factor is pushing some people out of the market, or not out, but maybe they're going and looking at a different type of home, price point, area, town. But the affordability factor is something to consider. It doesn't mean that you're going to be able to offer 25, 30, $50,000 less. You're just going to have to compare that there's only maybe 2, 3 other people that you are actually still in competition with for that home. So we're back to where it always was. And now the things that I talked about last week in our video last week is that we're seeing the terms come back. These great protections that were in the financing contingency, appraisal contingency, home inspection contingency. I mean, these were a part of our contracts, and it was normal. Home sale contingency. I made a prediction that I think by the end of the year or before that, we'll start to be able to see that again. Why not? If we have a great buyer the quality of the buyer is still the same. I mean, you could probably vouch for that, Pat, but why not? That was normal. It wasn't scary. Yes, there's a risk, but it was pretty normal for us to help a buyer that sell their house and go buy the new house and then take that as a coinciding settlement. And it was like, okay, well, they're selling this. We talked to that lender. It looks good. Let's make it happen. We did it. And it was okay because you had a professional that presented it, showing that the whole package was solid and you had good lending, that you're ready to go. So how do we answer that? I think what it is, it goes back to what you said, Peyton Manning, that the play has changed, but it's a play that we have solutions for, because if you're working with the right individuals, you have the experience of any type of market. We're here to help and make solutions anytime. We don't go, oh no, I'm sorry, we can't make that happen. It's never going to happen. It's not how we do things. We go, well, you know what? Let's think about this. There's a few other options we can think about. Home ownership. We're in the month of, isn't this the month that is home ownership month? This is the month that we're talking about it and telling people about it. It goes back to what you said. There's great equity in a home. We can see that someone that rents or someone that owns a home over 15, 20, 30 years, their portfolio, their nest egg, their equity position in what they have in value of their own home, at their own financial well-being, is so much greater because of owning a home. And there's just things that's so good about that. So we're here to provide solutions. Is it different? Yeah. Do you need to get past the headlines? Yes. Do you need to talk to us to show you what's really going on in the market? Because it's changing every week in every little zip code. Changing every week. There's some zip codes I look at today, 22152 this morning. Still, it's a crazy seller's market. The inventory level is still low. You go to another zip code, you see it creeping up. And so guess what that means? That maybe a little bit more, maybe you don't need a bid way over. Maybe you just come in straight at offer price and you get a home inspection contingency in there. So it's so hyper local, Pat. We have to be able to look and pinpoint each little area and talk to our other lender professionals out there to find out what's going on. And we're seeing it. It's for the right buyer that's ready to do something this year, this fall, this summer. It's a great opportunity, especially if you're thinking long term. And this is the same thing I said even in January. The same thing I said last year. We buy real estate for long term. It's always that way. And what's long term to you? 5, 7 years. Great. Perfect. If that's what you're looking for shorter term, then maybe think about how the type of loan program is going to be fit your needs, right?
Absolutely. Yeah. And I know we'll be talking about them in future discussions, because, for the longest time, your 30-year fixed mortgages was like, okay, let's just look at a 30-year. It's so low, let's go. But, the adjustable rate mortgages and different terms are coming into play now. And, even I had a shorter term loan at one point, knowing that first house I was in was not going to be my end all. And I wasn't prepared to be a real estate investor. When I bought my first homes, I wasn't going to keep it. Having a shorter term loan made sense because the interest rate was slightly lower, and cash flow was a concern at the time. So having that adjustable rate that was a slightly lower rate than the fixed was a great option. But this great discussion points, Tim. It's that we're always trying to learn and be and I want to take data points from industry professionals. I'm not just going to turn on the news and okay, they said it on the news, it must be true, because that's I think one of the reasons why I don't watch TV and stuff as much, unless I'm just watching a sporting event, is because the news is so biased now that it's hard to know what is actually factual data points. But it's always educating ourselves and making sure that you surround yourself with a good team. Everything from the realtor to the lender, to the insurance person, to the financial planner, to the mover, the painter. It's nice having that sphere of people that you can go back to help you with that home ownership and taking care of the home as well.
Right. Well, Pat, it's been a pleasure talking to you this morning. Thank you for hopping in while I was I'm here on vacation, my last day, heading back up to the DC area tonight.
Hope you have a great time. You're in Texas, right?
I'm in Texas and enjoying, got my barbecue fix. You
Very good.
know, we got the heat, saw the Texas Rangers. It was good. So
Yep.
thank you so much for doing this. We'll make sure we get this out to as many people as possible to let them know about what's really going on in our local real estate market and how that affects them in their home purchases. So thanks again, Pat.
You got it. Thanks, Tim. Have a great safe travel back.